On December 23rd, 1913, just 2 days before Christmas, when most Americans were distracted with holiday preparations and most members of Congress had already left Washington for the break, President Woodrow Wilson signed into law the Federal Reserve Act, creating a central banking system that would fundamentally transfer control over America's money supply from the government to a cartel of private banks. And yet, if you ask most people today who owns the Federal Reserve or how it actually works, they'll either have no idea or they'll incorrectly assume it's a government agency, completely unaware that the institution that controls their economic destiny is actually a private corporation owned by member banks that profits from creating money out of nothing. What happened in those final days of 1913 wasn't democracy in action. It was one of the most sophisticated financial coups in history, a carefully orchestrated plan that had been decades in the making, executed when opposition was weakest and public attention was elsewhere, establishing a system that would allow private bankers to create money, lend it to the government at interest, expand and contract credit at will to create booms and busts, and systematically transfer wealth from productive workers to financial manipulators. The truly shocking part is that this wasn't done in secret. The act was publicly debated and legally passed, but the real nature of what was being created was so carefully concealed behind technical language and false assurances that most people had no idea they were witnessing the privatization of their monetary system. And by the time the implications became clear, it was far too late to reverse. To understand the magnitude of what was stolen in 1913, you need to go back to the Founding Fathers, who were deeply suspicious of central banks precisely because they understood that whoever controls the money supply controls everything. And they had seen firsthand how the Bank of England had used its monetary power to manipulate the British economy and fund endless wars. Thomas Jefferson warned that if the American people ever allowed private banks to control the issue of their currency, first by inflation and then by deflation, the banks and corporations that would grow up around them would deprive the people of all property until their children would wake up homeless on the continent their fathers conquered. And this wasn't hyperbole or paranoia. This was wisdom born from studying monetary history and understanding how centralized control of money inevitably leads to the enrichment of the few at the expense of the many. For most of the 19th century, America resisted the creation of a permanent central bank. Yes, there were two failed attempts with the first and second banks of the United States, both of which were eventually shut down because Americans understood the danger they represented. But the banking elite never gave up. They simply waited for the right crisis, the right political moment, the right combination of circumstances that would allow them to finally achieve what they had wanted all along. That moment came in 1907 with the Panic of 1907. A financial crisis that began when the Knickerbocker Trust Company failed and triggered a bank run that spread throughout the financial system. And while the crisis was eventually contained through the intervention of J.P. Morgan and other powerful bankers who organized private bailouts, the panic created exactly the political climate the banking elite needed to argue for a central bank. The official narrative was that America needed a lender of last resort to prevent future panics, needed elastic currency that could expand and contract with economic needs, needed professional management of the monetary system rather than the chaos of thousands of independent banks. And on the surface, these arguments seemed reasonable enough, but what wasn't mentioned was that the Panic of 1907 may itself have been engineered or at least exploited by the very bankers who were now proposing the solution, that the boom that preceded the bust had been fueled by reckless lending by these same banks, that the crisis could have been prevented by honest banking practices rather than requiring a central bank to bail out speculators. What would you do if you discovered that the people offering to solve a crisis were the same people who caused it? Would you trust them with even more power? Or would you recognize that they were using the crisis as an excuse to consolidate control over the entire system? The creation of the Federal Reserve wasn't accomplished through honest debate where both sides were equally represented and the public was fully informed. It was accomplished through a series of calculated maneuvers that began with a secret meeting on Jekyll Island in November of 1910. The most powerful bankers in America, representing about 1/4 of the world's wealth at the time, traveled under assumed names to this private island off the coast of Georgia, where they spent 9 days drafting the legislation that would become the Federal Reserve Act. And they did this in secret because they knew that if the public discovered that the banking elite were writing their own legislation to give themselves control over the nation's money, there would be overwhelming opposition. Senator Nelson Aldrich, who organized the meeting, was the grandfather of Nelson Rockefeller and had close ties to the banking establishment. And the other attendees included representatives from J.P. Morgan, the Rockefellers, Kuhn Loeb, and other major financial houses. And together they designed a system that would appear to be government-controlled but would actually be run by and for the benefit of private banks. The brilliance of their plan was in the deception. They created regional Federal Reserve banks that would be owned by member banks. But they obscured this ownership through complex structures and called it the Federal Reserve System as if it were a government agency. They included government appointees on the board of governors, but ensured that the real power rested with the regional banks and their member bank owners. They made it appear democratic and decentralized, when in reality it was oligarchic and centralized in the hands of the largest New York banks. When the Federal Reserve Act was finally introduced in Congress, it faced significant opposition from representatives who understood what it really was. Congressman Charles Lindbergh Sr., father of the famous aviator, warned that the act established the most gigantic trust on earth, and that when the president signed it, the invisible government, by the money power, would be legalized. Congressman Louis McFadden would later call the Federal Reserve a private credit monopoly that preys upon the people for the benefit of itself and its foreign customers. But these warnings were drowned out by supporters who had been persuaded or bribed or deceived into believing that the Fed would prevent financial panics and stabilize the economy. The act was strategically brought to a vote just before Christmas, when many opponents had already left Washington, and it passed the Senate 43-25 and the House 287-85, and President Wilson signed it into law on December 23rd. And with that signature, control over America's money supply was transferred from the people's elected representatives to a private banking cartel. Wilson would later allegedly express regret, reportedly saying that he had unwittingly ruined his country and that a great industrial nation was now controlled by its system of credit. But whether he genuinely regretted it or was simply a willing participant in the deception, the damage was done and would prove nearly impossible to reverse. The immediate effects of the Federal Reserve's creation weren't obvious to most Americans. Life went on much as before. Banks still operated. Currency still circulated. Commerce continued normally. But beneath the surface, fundamental changes were taking place in how money was created and controlled. Before the Fed, money creation was limited by the availability of gold. Banks could only lend money they actually had or could reasonably expect to collect. And while this system wasn't perfect and did experience periodic crises, it had natural limits that prevented unlimited expansion of credit and currency. After the Fed, money creation became a matter of policy rather than physical limitation. The Fed could create reserves out of nothing and loan them to banks, which could then multiply those reserves through fractional reserve lending, meaning that for every dollar of reserves the Fed created, banks could lend out $10 or more. And this meant that the money supply could be expanded at will without any connection to gold or any other real asset. The Fed claimed this elasticity was necessary to accommodate the needs of commerce. But what it really meant was that those who controlled the Fed could determine who got access to newly created money and on what terms, which gave them enormous power to favor certain industries and businesses over others. To create booms by expanding credit and busts by contracting it, to transfer wealth from savers to borrowers and from the productive economy to the financial sector. If you're starting to feel a sense of dread as you realize that the institution controlling your money isn't working for you, but for the banks that own it, if you're beginning to understand that the booms and busts you've lived through weren't natural or inevitable, but were engineered, then you're starting to grasp why this history matters. Subscribe now, because what comes next will show you exactly how the Fed has used its power over the past century to systematically transfer wealth upward. Within 6 years of its creation, the Federal Reserve would engineer its first major expansion and contraction of credit, the boom of the 1920s, followed by the crash of 1929 and the Great Depression. And while mainstream historians attribute the Depression to various market failures and policy errors, the reality is that the Fed created the conditions for both the boom and the bust. During the 1920s, the Fed dramatically expanded credit, making money cheap and easy to borrow, fueling speculation in stocks and real estate, creating the illusion of endless prosperity. And when asset prices had been inflated to unsustainable levels, the Fed then contracted credit, making money scarce and expensive, triggering the crash that wiped out millions of investors and thousands of banks. This wasn't incompetence or accident. This was the deliberate use of monetary policy to transfer wealth from ordinary investors who bought at the top to the banking elite who sold before the crash and then bought back assets at pennies on the dollar during the Depression. Benjamin Strong, who headed the New York Federal Reserve Bank during this period, coordinated closely with the Bank of England to manipulate interest rates and credit conditions, and the evidence suggests this was done intentionally to consolidate financial power in fewer hands, to eliminate smaller competitors, to make the public desperate enough to accept even more government and Fed intervention in the economy. The Great Depression was used to justify the next major expansion of federal power over money and banking, with President Franklin Roosevelt using the crisis to confiscate gold from American citizens through Executive Order 6102 in 1933, making it illegal for Americans to own monetary gold and forcing them to sell it to the government at $20.60 per ounce. And then immediately after collecting all this gold, the government revalued it to $35 per ounce, essentially stealing about 40% of the value from everyone who had been forced to turn in their gold. This confiscation was justified as necessary to fight the Depression, but the real purpose was to ensure that Americans couldn't use gold as an alternative to Federal Reserve notes, couldn't escape the monetary system the Fed controlled, couldn't protect their savings from the inflation that would inevitably come from the Fed's money creation. Along with the gold confiscation came the creation of the Federal Deposit Insurance Corporation, which sounds like consumer protection but was really a way to make people feel safe keeping their money in banks even when those banks were making risky loans. And the separation of commercial and investment banking through Glass-Steagall, which temporarily limited some of the worst abuses but would eventually be repealed when it became inconvenient for the banking elite. Through all of this, through the boom and bust of the 20s and 30s, through the Second World War, which was financed by massive Fed money creation, through the post-war period when the Fed helped fund the expansion of government power, the fundamental pattern remained the same. The Fed created money out of nothing, loaned it to the government and two banks at interest, expanded credit to create booms, and contracted it to create busts. And through every cycle, the banking elite grew wealthier, while ordinary Americans saw their purchasing power steadily eroded by inflation. The Fed claims its mandate is to maintain stable prices and maximum employment. But if you look at the actual results over the past century, prices have risen by over 2,000% since 1930, meaning the dollar has lost more than 95% of its purchasing power, and employment has become increasingly precarious. As the boom-bust cycles have grown more severe, but while the dollar has lost value for ordinary people using it to buy goods and services, it has been a machine for generating wealth for those close to the Fed who get access to newly created money first, who can borrow at low rates and invest in assets that inflate in value, who profit from the volatility they help create through their control of monetary policy, the connection between the Federal Reserve and every major economic crisis since. 1913 is impossible to ignore once you understand how the system actually works, because the Fed doesn't prevent crises, it creates them. This is what central banks do. They expand credit beyond sustainable levels, creating artificial booms where everyone feels wealthy and takes on debt. And then they contract credit, triggering busts where debt becomes unpayable and assets must be sold at fire sale prices to those who positioned themselves for the crash. This pattern repeated in the inflation of the 1970s, when the Fed printed massive amounts of money to fund Vietnam and Great Society programs, causing prices to soar until Paul Volcker was brought in to deliberately crash the economy with 20% interest rates that destroyed businesses and threw millions out of work. It repeated in the dot-com bubble of the late 1990s, when Alan Greenspan kept interest rates low and praised the new economy while speculators bid technology stocks too absurd valuations, only to crash when the Fed tightened and reality reasserted itself. It repeated in the housing bubble of the 2000s, when Greenspan again kept rates at historic lows and encouraged people to take out adjustable rate mortgages, inflating home prices to levels that couldn't be sustained. And when the inevitable crash came in 2008, the Fed's response was to create trillions of dollars out of nothing to bail out the very banks that had caused the crisis. And here's where the pattern becomes most clear. Here's where you can see the true purpose of the Federal Reserve, because every time there's a crisis, every time the system threatens to collapse under the weight of all the bad debts and malinvestment that Fed policy encouraged, the response is always the same. Create more money to bail out the banks, make the problems bigger, transfer more wealth from taxpayers to bankers, and ensure that those responsible for the crisis profit from the bailout. After 2008, the Fed created over $4 trillion through quantitative easing. purchasing toxic mortgage-backed securities from banks at face value when they were worth a fraction of that, essentially transferring trillions from the public to bank shareholders. And they did this while millions of ordinary Americans lost their homes to foreclosure, lost their jobs in the recession, lost their savings to near zero interest rates that the Fed maintained to help banks rebuild their balance sheets. Do you see the pattern now? Do you understand that the system isn't broken? It's working exactly as designed to transfer wealth from the many to the few, from productive workers to financial manipulators, from savers to speculators. And the Federal Reserve is the mechanism that makes this transfer possible. What would your life look like if the Federal Reserve didn't exist, if money couldn't be created out of nothing by unelected bankers, if credit expansion and contraction couldn't be used to engineer booms and busts? If the value of your savings couldn't be silently stolen through inflation, if the government had to actually collect taxes or issue bonds that people voluntarily bought rather than selling debt to the Fed in exchange for newly printed money? This isn't a hypothetical question. This is how America functioned before 1913. And while that system had its problems, it didn't have the systematic wealth transfer, the endless boom-bust cycles, the steady erosion of purchasing power, the massive accumulation of government debt that has characterized the Federal Reserve DRE. The century before, the Fed saw periods of deflation where the dollar gained purchasing power, where savings actually grew in real terms, where economic growth came from productivity improvements rather than credit expansion. And yes, there were financial panics, but they were shorter and less severe than the Great Depression or the 2008 crises. And they didn't require massive bailouts of politically connected banks, because banks that made bad loans were allowed to fail and their assets were purchased by better managed institutions. The question you need to ask yourself is why we're told that the Federal Reserve is necessary. Why we're assured that central banking is modern and scientific, and that any alternative would be chaos, when the actual evidence of the past century shows that the Fed has presided over currency, debasement, economic instability, wealth inequality, and the transfer of trillions of dollars from the public to the banking sector. The answer is that those who benefit from the current system control the narrative. They fund the economics departments that teach students that central banking is necessary. They own the media that reports on Fed decisions as if they're handed down by wise experts rather than by a private cartel serving its own interests. They finance the politicians who defend the Fed and attack anyone who questions it. This is how the system perpetuates itself, not through superior performance or demonstrated benefits to the public, but through control of information and institutions, through the illusion that there is no alternative, through the complexity and opacity that prevents most people from understanding how they're being robbed. Here's what they don't teach you in economics classes, what the financial media carefully avoids discussing, what politicians from both parties refuse to acknowledge, that the Federal Reserve is the mechanism by which private banks have captured control of the public money supply. And everything that has happened since 1913 flows from that original sin. The $16.9 trillion national debt exists because the government can borrow from the Fed rather than having to balance its budget. The asset bubbles that have made housing unaffordable for younger generations exist because the Fed keeps interest rates artificially low to benefit banks and speculators. The inflation that has destroyed 95% of the dollar's purchasing power exists because the Fed has created trillions of dollars out of nothing. The too big to fail banks that dominate the economy exist because the Fed protects them from competition and bails them out when their gambles fail. Every major economic problem facing America today can be traced back to the Federal Reserve and its power to create money and manipulate credit, and yet this institution remains largely immune from operating with minimal oversight, making decisions in secret that affect hundreds of millions of people, transferring wealth on a scale that would make the robber barons of the 19th century envious. The creation of the Federal Reserve in 1913 wasn't the end of the story, but the beginning. Because once private banks gained control of money creation, they used that power to steadily expand their control over the entire economy. And each crisis they created became justification for giving them more power, more tools, more ability to manipulate markets and transfer wealth. We saw this after the Great Depression with new banking regulations that entrenched the largest banks. We saw it with the abandonment of gold backing in 1971 when Nixon closed the gold window. We saw it with the deregulation of the 1980s and 90s that removed the last constraints on bank speculation, We saw it with the bailouts of 2008 that made clear banks would never be allowed to fail, regardless of how reckless their behavior. And we're seeing it now with talk of central bank digital currencies that would give the Fed direct control over every transaction. The ability to program money to expire if not spent, to track everything you buy, to shut off your access to the monetary system if you don't comply with whatever rules they decide to impose. So, we are 111 years after the Federal Reserve Act, living in a system where private banks create money out of nothing and charge interest on it, where boom-bust cycles transfer wealth from the many to the few, where purchasing power steadily erodes despite promises of price stability, where the largest banks are more powerful than ever and backed by implicit government guarantees funded by taxpayers, and most people still have no idea that the Federal Reserve isn't federal and has number reserves, that it's a private corporation serving private interests, that it was created through deception and has operated through deception ever since. But understanding this history is the first step toward changing it, because the current system isn't natural or inevitable. It was created by people with specific interests, and it can be changed by people demanding something better, whether that's returning to commodity-backed money, allowing competing currencies, ending the Fed's monopoly on money creation, or some other reform that puts control of money back in the hands of the people rather than a banking cartel. If this revelation has shaken your understanding of how the monetary system works, if you're beginning to see that the institution you thought was protecting economic stability is actually the source of instability, if you're feeling anger at the deception that has been perpetrated for over a century, then you need to see what we reveal next. Because the Federal Reserve is just one piece of a larger system of financial control, and understanding how all the pieces fit together is essential to protecting yourself and demanding change. Subscribe now, because in the next episode, we're going to show you exactly how the Federal Reserve works with other central banks to manipulate global currency markets. And once you see that international dimension, you'll understand that this isn't just about American monetary policy, but about a global financial system designed to concentrate wealth and power in fewer and fewer hands. And that understanding is essential to building the kind of future where money serves people rather than enslaving them.